Our two main investable markets are the leveraged loan market, which is a floating rate market, and the high yield bond market, which is fixed rate. In terms of the high yield market specifically, we've seen much higher quality, a higher quality mix show up in the high yield market. Corporates are going to the high yield market at a higher rate than private equity owned companies, which are largely going to the loan market. So from a fundamental standpoint, amidst rising rates, we've actually seen high yield issuers be more resilient to the changes. Because it's a fixed rate market, we've obviously seen a lot of price volatility in the security prices that we're investing in, but we're, I think, seeing stronger company fundamentals supporting those capital structures. And so cost of capital going up, but companies are able to finance themselves. On the loan side, it's not a one-size-fits-all answer, but I think in general, the fundamentals are under more pressure in the loan book. Again, they tend to be a higher percentage of the market is private equity-owned companies that put more leverage on companies. And so surprisingly, actually leverage in our loan portfolio, despite it being top of the capital structure, is higher than leverage in our unsecured bond portfolio. So a little counterintuitive. And because it's a market with floating rate exposure, we're seeing cost of capital being felt, the changes in cost of capital being felt much more quickly. And so interest coverage is coming down pretty quickly in the loan book relative to high yield. And so in general, I would say we're more cautious on the fundamentals on the loan side of the equation, that we're seeing investment opportunities created by that dislocation as well. So we have seen companies that are having to just bring more creative thinking to capital structures today. I think in general, with the changes in interest rate policy, we're seeing returns that historically flow to the equity part of the balance sheet transition to paying more interest expense to debt holders, which is great in our seat. But along with that comes, refinancing of challenging capital structures is getting more tricky. And so we have seen issuers in general show a bias to bring down leverage. Oftentimes in some of these refinancing solutions, sponsors or equity holders are having to contribute new equity to get those deals done and to control kind of the interest expense that they're paying on their balance sheet. I wouldn't say that's a theme that's showing up across the board, but certainly has been involved in many of the trickier situations out there. So we have seen defaults tick up, decently so far in 2023 year to date. I think one of the key metrics that we look at is the default rate is picking up faster for smaller issuers, and you see that the number of defaults is outpacing the dollar-weighted defaults. I think the other big trend that we've seen so far is that upon event of default, the recovery rate, the ultimate outcome that investors are seeing in those defaulted situations has come down. I think on a go-forward basis, we're expecting that trend to continue. I think we have sectors that we expect to be disproportionately harder places to be, and so we're doing our best to avoid those sectors and those companies. But given the changes in cost of capital and the volatility in the financing markets, we're expecting defaults to continue to tick up. So I would say defaults are at a more typical level. They might have been a bit understated when you go back to the 2021 type of period, just because financing markets were very open to issuers, and so there was an ability to kick the can down the road for companies that had showed sufficient strength to access the market. Companies could go to the loan market, the bond market, the convertible market, the equity market, and so there was a lot of ways to address any need for capital. That access to capital is getting more complicated today. So I think it is, you have seen a step up in default rates so far from what was a fairly low level to begin with. But we had seen defaults. In particular, I think the energy sector in the early kind of COVID recovery period was a sector that saw disproportionate defaults. That has really been cleaned up in that 2020, 2021 period. And so energy has been a default-prone sector historically, that we're seeing stronger performance amid higher energy prices and with many of the weakest balance sheets already having been dealt with. So the sectors that we're seeing cracks in, I would say healthcare is the most, the most extreme of these. Just the number of issues in the market seems to grow kind of by the day, by the week. Taking hospitals as an example, you've got nurse labor and doctor labor that's gone way up. The cost of medical devices and equipment has risen, but there are regulatory constraints on what companies are able to or not able to do in terms of passing that on to the end consumer. And so healthcare has been a place of pretty real stress in the markets. The other sector that I would say we're watching very closely, I think thematically we've view this in the camp of more of a secular decline type of industry, but cable and telco or cable and telecom are segments where they're pretty levered balance sheets to begin with. You've seen more treading water in terms of top line performance, but some impact from margins. And so the combination of higher cost of capital, declining valuations, and a lack of growth has made those trickier places to invest. I think because many of the healthcare businesses are asset-light businesses, those situations where you get into a default can be pretty painful from a maximizing value through that process. I would say we could see some opportunity from a more positive lens in some of these cable telco situations. And so while I expect to continue to avoid many of the healthcare situations, I think we'll dip our toes in cable telco at the right time.